Hi folks, welcome to the video. Please do read the disclaimer. Today's topic of discussion is about gold. What if gold can't beat equities or even FDs? That is the discussion. We're going to do a lot of data mining and see what has been the patterns of gold investing and compare it with the fixed income and equities. Although my personal view remains that gold is a very important asset in your portfolio, and ideally regardless of its returns, it should be there because it is a insurance and a hedge to your portfolio. But for academic reasons, a lot of folks do want returns to be compared, so we will compare the returns as well. Now gold in the last 6 years has had three major trends. 2018 to 2020 made it was a nice pre and post COVID rally, and then when equities took off post COVID, gold went into a slumber sideways for 3 years after going up from nearly 3,000 rupees to a gram to 5,000 rupees to a gram. And then it's consolidated for nearly 3 years. And then from 5,000, we have now gone suddenly to nearly 11,000 per gram. And that has happened in less than 2 years. So since October 2023, gold is up in Indian rupee terms 111%, while Nifty is up 29%. And in the last 6 7 years, we've had a fantastic run from nearly 3,000 rupees per gram to 11,000 rupees per gram. So everybody is quite kind of convinced now that they must have some allocation. This is very different from 4 or 5 years back when gold was, an unwanted child. Nobody wanted to touch gold, and now there is a FOMO that we must have gold, but the rising prices is causing people to rethink whether they can, whether they should, whether it is coming near a peak, and will there be a pain period ahead. So we made this video earlier also. Ignore gold at your own cost. You can watch this video as well. But if we see the larger picture, uh, we have discussed all these super rallies and super sort of moves in gold in the 60s, 70s, and then the 2000s, and then the more recent ones, four phases of gold. And we've dived deeper into gold correction. In this video, we will see that. Assuming that you are the most unlucky investor in gold, let's assume that you have the worst timing and you are coming in at the peak of each of the gold rallies, and it is like a gift, god's gift to you, that whenever you will buy, that will be the peak of the rally. Let's assume that for argument's sake, and see what we would have done in the past gold moves. So what would your xirr would be if you started sip at peaks? uh, how long did it take to recover to new highs? How long did it take to beat FD returns? And what percentage of SIP duration was the current value of SIPs lower than the invested value? So basically, as you were sipping, how much time were you under your actual investment versus over it? So three peaks we have considered in this study. Peak number one was January 80. January 80 was 230 rupees to a gram, and that move was basically coming after 7 years of amazing move of almost 10x gain. So 23 rupees going to 230. And let's say on January 80 you were destined to buy or start your investing, and we'll consider both lump sum as well as gradually sipping through. Peak number two was January 1996, where the rate was nearly 500 rupees, and that has come from approximate a bottom of about 100 rupees, so 5x in the previous uh, 13 14 years. And then it plateaued and then went up again from 500 to about 3500, and then a bottom was made nearly at around 2300, and from 2300 we've gone to nearly 11,000. So if we were to see these peaks and compare it with historical FD returns. This has been the historical FD returns in the last 30, 40, 50 years, and we'll compare it with that. So peak number one, January 80 to October 89 was the period where no new highs were made. 9 years it took to come to a new all-time high, but always remember that this was a 10x kind of move just before that. So after a 10x kind of move, a 9 year wait period is not such a bad deal. Drawdown of 52%. So over a period of 45 years, since 1980 till now, gold CAGR, if you had invested lump sum at the beginning of at the top of the peak, it would still be 9.2%, whereas FD CAGR from that point would have been 8.2%. Of course, FD CAGR uh, was gaining in relation to gold for most of the period, but then very recently gold beat that return. So this is the worst kind of point for lump sum investing. And then if you see SIP investing, where you would have invested every month for 549 months, there you would have seen that your number of months where current value of your investment is less than invested value is only 43 months. So 8% of the duration you were underwater, and you created a XIRR of 11.25% if you sift through the last 45 years. If I see the next peak in Jan 96, and from there we had a drawdown of 30% in the next few years, and it took 6.5 years to come back to a new all-time high. This is 19 years period since then. From a lump sum perspective, if you invested in 1996, you still got 10.8% as of today. And FD would have given you about 7.5%. We are assuming there are no taxes in this world. Uh, and it took 12 years to beat the FD on this model. But if you were sipping through this period and only 14% of the time were you below your invested amount, and you created a XIRR of 13.3% even after starting from the worst phase in 1996. In the peak of September 12 to July 19, uh, you basically had a drawdown of 30%, uh, and 7 years to come back to a new peak. And if you did a lump sum, you still got 9.8%, but on an FD, you would have made 6.8%, and only recently the lump sum amount beat the FD. But here's the wonderful thing, that if you had invested in a SIP basis, then you would have basically the number of months invested under your capital would have been 26%, and you would have made 15.9% XRR on this period, which is a very handsome XRR, given that 12 onwards actually there was a gold bear market for almost 8 or 9 years. So if we were to sort of tabulate these three periods, three peaks, the first drawdown was 52%, the next two had 30% drawdowns. It took 9 recovery years in the first one, 6.5 to 7 in the second and third one. Lump sum investing would have yielded you somewhere around 10% on average in all three, which is still not bad considering that you are the most unlucky investor. And gold XRR, if you had sipped through, would have subsequently gained very nicely from 11% to 13% to almost 16%. So, in the worst case situation, if you are coming gradually in the market, there is really nothing to worry about. Gold should actually not be viewed primarily as a return generating asset, as I mentioned earlier, but directly sort of, it's an antidote to risk assets. And whenever you are having trouble in the conventional assets, gold is the one that saves you. So the core purpose is stability, core purpose is insurance, core purpose is the hedge, and it provides a balance when other assets are falling. Commodities typically move in long cycles. Gold has delivered healthy long-term CAGRs even when invested from anywhere in the cycle. SIPs have proven very, very powerful, whether they are SIPs in ETFs, whether they are SIPs in physical gold, whichever way. And XRR of 11 to 16% can be achieved even while starting at the worst time. So, strategic exposure to gold helps investors remain invested with confidence, because you are able to go through the troubled times without too much dent in your overall, not just your portfolio, but your confidence in investing as a whole. So that's where we are on this subject. Let us know in the comments what are your views about it. Do you invest SIPs lump sum in gold, and how do you manage your gold investments? Do you try to compare the performance of gold with other asset classes, or you only view it as an insurance? And you can also watch this other video uh, for if you like this current one. So thank you so much for watching this, and special thanks to my friend Anu, who gave me this idea for this particular video. Do subscribe to the channel, and do like and share this video. Thanks. Bye.